Private markets are an important differentiator for RIAs today, really for a couple reasons. First, when you look at the capital markets over the past decade or two, more and more opportunities have been staying private or even going private. And if you look at the public markets, there's been more concentration risk in the equity side, and there's been less opportunities in the public debt side as well. So it makes sense that there's been a growth of the private markets, really when it comes to the opportunity set for clients. They're also becoming a differentiator for clients because of the ways that it can help with achieving just long-term growth goals, higher expected returns due to illiquidity premiums, and also even higher potential yields for income-producing portfolios. And then I think the last reason I would state for why they are becoming a differentiator is really from the client's perspective. More and more clients are looking to their advisors as a way to access vehicles they can't access on their own and to learn about how to invest in something that's different than just buying stocks or ETFs or mutual funds. A lot of our clients, for better or worse, feel very adequate in investing on their own in some of those spaces. And so they're looking for their advisory firms to bring something different, bring a different level of expertise in other areas of investments. Clients span a whole broad range of categories. We have ultra high net worth clients, institutional clients, who in many cases may be very sophisticated when it comes to private market investing. But as we go further into the broader space of mass affluent clients, many clients still view private markets as something that should act very similar to public markets. They don't necessarily always understand what it means to lock up their money for long periods of time. They don't understand always how leverage works in private market investing. And they also sometimes don't understand the different and more complicated structures, including fee structures as well. And so there is a deep level of expertise that goes into due diligencing private market investments, very different than what goes into looking at more broad-based public market investments. Practical steps RIAs can take to implement private markets into client portfolios is really starting high level and developing an asset allocation framework, really based along the lines of time horizon, risk, but also liquidity needs for different clients, and thinking through the sizing of the private market allocations. Diversification is extremely important. So it's also important when we think about private market allocations and those high-level frameworks for their broad client base, making sure that we have adequate diversification across GPs, across different private market funds, not just picking one or two, because as we know, there's broad dispersion in returns in private markets. So it's really important to also make sure you're working into that framework diversification. So at Mercer Advisors, we have a dedicated team that for the past 25 years, all we've been doing is researching and due diligencing private equity, venture capital, private credit opportunities, private real estate opportunities. So that team is part of our investment committee in-house. And when they find deals that they feel are top quartile deals or top performing GPs, we actually then not only select and allocate to them, but we put them into a vehicle that provides diversification for a single private market solution for our clients. So for our clients, instead of having multiple subscription documents, multiple K1s, there's one allocation, one K1, and we don't charge any additional fees to bring it all together under one wrapper. So that's one of the big things that we do that's very different at Mercer Advisors. Everything really starts at the high level when it comes to the IPS for the client and the asset allocation framework that we're targeting for that client. And so for clients maybe with $1 million, that's going to look very different than a client that has $100 million. And so thinking through the structures, the allocations, the vehicles, it's important that we have a game plan that starts with financial planning, starts with high-level risk management, liquidity management, before we ever get into individual fund selection. And so that's the most important piece to the puzzle, is to lead with that planning, lead with that framework, and then you should be fine from a risk perspective as long as, like I said before, working in diversification, working in top-tier managers. Well, I think the biggest trend that's going to shape the future for private market access for RIAs seems to be the more liquid structures, the attempts at bringing private market allocations into ETFs, potentially bringing them even into other different, more liquid fund structures. The big thing that everyone needs to remember is that these are still illiquid investments under the hood. So even if it's in an ETF and you may be able to sell out of it each day, if the market has a big pullback, These aren't mark-to-market assets. And so we really urge our clients to think of these as long-term 10-year plus investments, regardless of the vehicle, whether it's an ETF, interval fund. To us, it's a 10-year lockup, regardless, because we're looking long-term for these investments.